If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Russia's economy is collapsing faster than anyone predicted. GDP growth has plummeted from 4.1% to just 1.4%. Inflation is crushing families at over 9% annually. Interest rates have skyrocketed to 21%, the highest in decades. Unemployment sits at a deceptive 2.2%, masking a labor crisis. Excessive military spending continues to distort the entire economy. While defense sectors boom, civilian industries are collapsing. Sharp inflation and high interest rates are crushing domestic demand. Labor force contraction from mobilization and emigration has created artificial low unemployment. External pressures from sanctions and declining oil prices are eroding fiscal buffers. Record low unemployment masks workforce fragility and skills mismatches. Construction and real estate sectors show mounting stress. Non-performing loans are rising as business confidence plummets. Private sector activity contracts under mounting economic constraints. To truly understand the economic pressures at play, we must dive deep into the data. The headline figure is stark. GDP growth has collapsed. After a robust expansion of 4.1% in 2024, driven by a surge in state spending, momentum has vanished. The first quarter of 2025 registered a meager 1.4% growth rate. This isn't just a slowdown, it's a near standstill. Looking ahead, full-year projections now hover between a narrow 1 to 2% band, a dramatic deceleration. This signals that the underlying private sector engine is sputtering, unable to carry the load. On the surface, the labor market appears stable. The official unemployment rate holds at a remarkably low 2.2%, unchanged from May. However, this number is deeply misleading. It masks a more troubling reality, a significant contraction in the labor force itself. Military mobilization and emigration have removed hundreds of thousands from the available pool. Therefore, the low unemployment rate isn't a sign of a healthy job market, but a reflection of a shrinking workforce and deepening skills mismatches. This creates production bottlenecks and wage pressures that fuel inflation, even as the broader economy slows. Caught between fighting inflation and preventing recession, the central bank is walking a tightrope. It held its key interest rate at a staggering 21% through April. With the economy faltering, policymakers began a cautious easing cycle. Subsequent cuts brought the rate to 18% by July. But these are still punitive levels. For a small business seeking a loan or a family hoping to finance a purchase, borrowing costs remain prohibitively high, effectively freezing private investment and credit-driven consumption. This tight monetary stance has dampened investment and household consumption across the board. The reason for this harsh policy is persistent inflation. The headline rate peaked at a painful 10.1% in February. While it has eased to 9.4% by June, this is still more than double the central bank's target. Digging deeper, core inflation, which excludes volatile food and energy prices, hovered near 8.7% in June, indicating price pressures are broad-based and embedded. Perhaps most concerning, these numbers are shaping public psychology. Inflation expectations among consumers have become unanchored, soaring to 13%. This creates a dangerous feedback loop, where workers demand higher wages, forcing businesses to raise prices further, entrenching inflation. Examining the government's balance sheet reveals a paradox. Government debt to GDP was approximately 16.4% in 2024. Broader figures place total gross government debt near 20.3%. These figures seem low, but they don't signal strength. They reflect an inability to borrow on international markets, severely limiting fiscal flexibility. The state must rely on domestic sources, and with a projected budget deficit of 1.5% for 2025, the pressure is mounting. Oil revenue shortfalls are a key contributor to this fiscal pressure, further tightening the government's straitjacket. These dynamics illustrate a wartime-pressed economy transitioning from expansion to a pronounced slowdown, with growth sustained entirely by government spending. This creates a two-speed economy. While defense industries boom, private sector activity contracts. The slowdown in machinery and consumer goods manufacturing signals this weakness. This pain cascades to households as elevated prices in food, services, and utilities erode real incomes. External pressures also limit export expansion and energy revenue. This leads to the next point of failure, the financial system. Reports cite rising stress in the construction and real estate sectors. As projects stall and loans go bad, this mounting stress in the banking sector threatens financial stability. Frozen credit markets pose additional risks to economic recovery, creating a precarious outlook for the months ahead. The economic outlook is clouded by several significant risks. Chief among them is a deeper recession if inflation lingers and growth fails to rebound. Stubborn core inflation could force the central bank to maintain high interest rates for longer than anticipated. If this restrictive policy coincides with weak consumer and business confidence, the economy could find itself trapped in a painful stagflationary environment of low growth and high prices. The state's finances are also on a knife's edge. Further oil price drops or severe penalties could depress state revenue catastrophically, forcing deep budget cuts. Compounding this, financial instability from banking sector stress threatens the entire system. Rising bad loans and exposure to interest rate volatility are creating vulnerabilities that could trigger a liquidity crisis and a credit freeze, paralyzing the economy. Looming over everything are long-term demographic challenges that are eroding workforce and consumption capacity permanently. An aging population increases social costs while reducing productive capacity. This structural crisis is severely compounded by brain drain and emigration. The continued exodus of skilled professionals and young graduates not only depletes the current talent pool, but also hollows out the next generation of innovators, creating a vicious cycle of decline. This complex web of risks leaves policymakers with a narrow path. Policy choices are constrained by the need to balance inflation control with growth stimulus. Gradual monetary easing may help, but excessive easing could reignite price surges, undoing hard-won gains. On the fiscal front, while low debt levels provide some wiggle room for targeted intervention, this space is severely limited by war expenditures and other resource constraints, making effective deployment a major challenge. Therefore, any support must be highly targeted. Emphasis on infrastructure and small business support could mitigate private sector contraction, while diversification efforts remain critical for long-term resilience. To address the labor crisis, population policies are essential. Incentivizing return migration of skilled expatriates and boosting female workforce participation through better support systems could unlock a significant new engine of growth, bolstering medium-term capacity and building a more resilient foundation for the future. In a constrained geopolitical environment, maintaining external stability is paramount. This means carefully managing the current account balance and the ruble's exchange rate to insulate the domestic economy from shocks. With traditional financial inflows gone, stabilizing revenue from commodity exports becomes critical for economic survival, securing the hard currency needed for essential imports and technology. The convergence of multiple pressures creates a perfect storm scenario. High inflation, restrictive central bank policy, a shrinking labor force, and soaring military expenditures are interlocking factors. Compounded by deepening geopolitical isolation, each pressure amplifies the others, creating a powerful force that actively decelerates growth. Historical precedents from other isolated economies suggest this difficult transition phase is not a short-term crisis. Instead, it could extend for several years, characterized by high volatility and a painful reorientation of economic activity. The sustainability of any performance during this period will be tested repeatedly, hinging on policy agility. Ultimately, structural flexibility in this constrained environment will determine the outcome. Russia's economic trajectory represents a transition from a state-fueled wartime expansion to a sharp slowdown. While 2024 growth appeared robust, driven by defense spending, 2025 reveals diminished momentum as that artificial stimulus proves unsustainable and underlying weaknesses are exposed. Although unemployment remains at record lows and debt stays manageable, the sustainability of current performance requires immediate policy intervention. Success hinges on policy agility, external revenue stabilization, and structural flexibility. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.